Well, people, it's that time of the year where we start to move into some seasonal weakness and or stall out in the S&P 500 and even the Nasdaq Composite. We'll be talking about that on today's Stock Market Brief Show. We'll talk about some more dramatic looking charts here too as well. It's hard to believe that we can potentially stall out when we're seeing some big mega cap names start to break out. All that and more on today's Stock Market Brief Show. Let's get into it. All right, everybody, let's take first look at the S&P 500 11 sectors. XLY, XLC led the way, basically flat to unchanged around the board here, except financials and energy led the weaker part of the S&P 500. Now, XLY, two of the top holdings, Amazon and Tesla, made some big moves today, and that's why we're seeing that lead the way. But Tesla reclaimed the year-to-date anchored volume weighted average price, and we saw some good volume there. We've actually seen some good volume pockets in and around there. So this is one of the trade ideas I've been talking about here for a while, and we're finally starting to break out. Are we going to get some more continuation and more upside? Perhaps. I took a little bit off the table, but I'm definitely keeping some runners on to hopefully catch a move up into and around 210 to 220. We'll see if we get there. Amazon also broke to a new all-time high today as well and happened to be on some good volume. So this one, right, could be one to watch for consolidation, see if it comes back in, and then play a continuation back up to the upside. But overall, very good looking chart and a strong breakout in this current moment. Microsoft also hit an all-time high here too as well. And this one's been coming off the year-to-date anchored view up, and it's basically been a one-way ticket up with no consolidation, really no consolidation or pullback to back test at this current time. Google also consolidated nicely over here, and we had a breakout not too long ago. It happened to be on some pretty decent volume, and now we're having a little bit of consolidation there take place on Google. Even take a look at Apple breaking out of this prior high over here, and we did that on some AI news, and it just screamed up for a couple of days, and now we're just consolidating sideways. It was up today as well. So it's hard to think that the markets can stall out when we're getting some of these larger market cap names continuing to rip. But mind you, we can always see things like Microsoft or Google come back in and consolidate and reset back up and so forth. And that could put a pause to markets. One of the interesting things from an intermarket standpoint are these assets right here. That's the 10-year yield and the dollar. And when these things move hand in hand, when they're up, you can see that there's a lot of red on the screen. We can even go out to the weekly time frame and look at the 10-year yield up here, the dollar here, right? Those two assets are in the green on the week. And with that said, you have a lot of stuff out here floating in the red for the week to date performance. And if you take a look at the dollar chart on the weekly time frame, this thing looks like it's gearing up to make a big move here, right? We're coming into this prior area of resistance, and we've been seeing quite a bit of strength, and the dollar is an incredibly important asset, especially from a correlated standpoint to many different various assets as well. What we've noticed in the past is when the dollar screams higher, could be a potential flight to safety, and we've seen the markets go down. We've seen various other assets go down on a rising dollar as well. The 10-year yield correlation, right? We'll take a look at actually long-term treasury yield correlation on a 10-day, 30-day basis. And what I'm noticing here is actually the correlation, there isn't one, right? There's really no crazy correlation on the 10-day, but there is still a negative correlation on the 30-day. So we'll see if this comes back in. And if that's the case, that means if treasury yields go up, right? That means the S&P 500 could go down when they're deeply negative, right? But when there's no correlation, right, yields can go up and the S&P 500 could go up, or they can go down, right? There's no correlation. So I like to look at the more extreme correlations to get a good gauge there. Speaking of correlations, though, if you do take a look at the yield curve has been inverting further and further, as you can see there, the 10-year, 2-year. And when that happens, you can see in the past, it goes deeper into inversion, while we're underneath the zero line, which means the curve is inverted. You can see the S&P 500 actually rallied in those times. So the question here is, if this starts to uninvert, would that put pressure back on the markets? I would imagine by looking at this chart, yeah, that would be the case if we begin to steepen, right? If the yield curve starts to steepen. Now, NDX seasonality chart over here, this has really kind of matched it to an extent at the beginning, but we didn't see this pullback. Then you can see we saw a little fall here, but it looked like a little bit earlier than when this happened. And this rally has been kind of moving hand in hand here too as well. The green line is where we are currently. The blue line there is the last 5 years. And you can see we're moving into this period where we kind of stall out and potentially dip. So these two charts over here, this is the S&P 500, this is by the Almanac Trader. You can see that we've seen some strength, and now there's question, are we due for a little bit of a mean reversion, looking at the sitting presidential running cycle, and then also the aggregate cycle there too as well. You can see basically what we showed on the prior chart. Same thing goes with the NASDAQ composite here too as well, where things have kind of died down from its pretty significant moves into and around July to mid-July. I thought this chart was pretty interesting from Tom McClellan. Is it actionable? I don't think so, but it is still nonetheless pretty interesting. He basically took M to the GDP ratio and shifted it forward 12 months, and he noticed three things. After you get a big surge in the ratio line, you'll get the markets to have a big response, and then you'll see that it'll start to die off, and then it goes against its message, and there's a payback period, and you'll see that time and time again. You get a big surge, the market responded, it started to come off, and then the market paid it back. Over here, right, you had a big surge, boom, you had a big response, started coming off. Guess what? The market's message paid back a little bit later. And what he's calling out here is we had a huge surge, not just a big surge, a huge surge. Okay, and the market is continuing to go higher as this ratio is coming off significantly steeper than have seen. Right, this is the steepest looking back on this specific chart, and it's going against the message, just like it went against here, and each time we did see a payback. So come to your own conclusions. Are we going to see something similar take place? If so, it's still hard to be actionable. So we like to get a little bit more tactical on lower time frames, and then see how the data progresses as time goes forward. But looking at this, some people might say, I'm going to short right now. But then again, we're seeing mega cap stocks break to new highs, which is not a bearish sign, right? It's not bearish when things keep going up. So we got to be tactical. All right, let's continue on here and go to what's going to be taking place tomorrow. So tomorrow we have durable goods, GDP. We have some more data out on Friday. Also Thursday, we had the presidential debate. I'm not thinking that we're going to see anything too crazy there that, could really move the markets. But nonetheless, the market is pricing this in terms of volatility. So just be aware of that. We'll go over the implied move here momentarily. As far as the S&P 500 goes on the daily time frame, right? We didn't move much today. It was rather choppy, and we've been in a tight range these last 4 days with a wide open range of risk. So in the next 2 days, I still strongly believe that we're going to be hitting 551 and or down here at 538. If we do come down here to 538, I've been paying attention to this lower anchored volume weighted average price and this gap fill from this prior gap up. And these can act as an area of confluence that if we start to see strength from it, we can potentially play and buy that dip. For example, if it did do that, it could just look like more of a flag pattern taking place in the SPY. Now, if we start to break up, I would be looking at the upper weekly expected move for potential profit taking going forward. Okay. Take a look at the SPY on the 15-minute time frame just to get a little bit more tactical. We did close above the 5-day moving average. It's still declining, so it is bullish, but with caution because we are starting to turn around. It's rather flat to neutral, but in recent 2 days, it has started to decline, okay? We're above the week-to-date anchor volume weighted average price here too as well. And if you anchor one to the high over here, you can see that we closed above that today. Going into tomorrow's trading session, we have a daily expected move of 543, an upper level of 547, and we're still above the upper month-to-date expected move right here too as well. We've came into it multiple times, and we started to move from that level. This reminds me of last month, pretty much to a T. We extended past it, we came back in, and we bounced from that specific level. NQ today, so this is a quick shot of the 30-second time frame on a daily one-day chart of NQ, and I just found it interesting today. It was all chop, right? We saw a big move down, big move up, big move down, and so forth, and we closed the day, pretty much at the highs of the day, but then we saw this big hit to the downside, and that was really caused by Micron. They reported earnings. Now, this is the time I'm recording this. The earnings call hasn't happened, so as we saw this big hit, it's always likely that we come right back up, but we'll see if it comes back down coming into tomorrow's trading session. But so far, the market did not like what it heard, and it came in a little bit. Now, another note on NQ's choppy price action, same with S&P 500s today. I mean, we looked at market net flow intraday on the live stream, and this wasn't giving us any edge whatsoever. It basically read out incredible chop, and that's what we got. So it's important to watch this. If you're on the live streams, I'll share it with you while it's live, but it shows the cumulative net premiums for calls and puts when it's above the zero line and so forth, and we have convergence down here. This tool right here is an incredible, helpful tool if you're trading intraday and you're trying to find out how, and if you don't want to fight against specific trends. So we'll talk more about that one on the live trading sessions if you're ever able to join in. If we take a look at Gamma, these are going to be the key levels to really hone in on. 5,500, that is still the call wall. Okay, so below 5,500, right? 5,450 is going to be the testing ground, the level that you don't want to break. Okay, that's the current level of support beneath us. If we start breaking above 550, we have about 50 points higher right here to 5,550. And then it opens the door to 5,600, which traders have been reaching out to. So if I show you what that looks like on a chart, here is 5,450, and that happens to be where the Gamma flip line is, and we're still holding that level. Okay, so dealers look to buy the dip, sell the rip, since we're above it. Okay, so if it comes down here, you want this level to hold. 5,500 has been kind of that pin, right? So above 5,500, we open the door to 5,550 and 5,600. That's how I would be looking at that. And then I'd be a buyer, basically be bullish when we're above the 5-day moving average, and if we can hold that Gamma flip line. But the moment that we start breaking from these levels, it's a time to be cautious. If we take a look at back month versus front month volatility, we're not overly extended, but when we come into 1.20 or 20%, basically it tells us that back month is above front month by 20%. We've came into periods where the market stalls out and or potentially pulls back in, and so forth. And we came up there just not too long ago, very close to it, and we stalled out a little bit, but we're still at elevated levels. So if this comes up, I would still expect that the market can stall out based off of seasonality, based off of where we lie as far as back month, front month volatility goes here too as well. Okay, let's take a look at some breadth charts. Breadth has been an incredibly helpful tool to gauge when we have internal weakness, but it also gives me a little bit more insight to some other things which I shared on Twitter, and I'll go over that here momentarily. The first one I like to look at is the percent of stocks above the 50-day moving average and the 200-day. And as the market's been pressing higher, what has these been doing? They've been kind of falling off, right? So they've been diverging. It shows us that while the market's moving higher, less and less stocks are participating above their 50 days and respectively 200-day moving averages. But what does that mean? Well, I shared this chart here on Twitter, and the note that I wrote was there's one of many ways to measure breadth is by looking at the percentage of stocks above their 200-day moving average. In this case, it's the NASDAQ composite, right? A big broad market. So here's the NASDAQ composite. This is the percent of stocks above their 200-day. Okay. When you start to notice the market rising, okay, like it's doing right now, but with fewer stocks participating, which it's doing right now, typically one of two things happen. The divergence resolves itself by the market pulling back, which we've seen here, boom, here, boom, here, boom, here, boom, boom, and not right here yet, not at the moment. Okay, so it can resolve itself like that, and those are the examples that I pointed out, but there can also be a significant catch-up trade involving all the underperforming names, meaning that all of a sudden breadth comes back into the market, okay? But this is what I know. Bad breadth or bifurcation, which is what we're seeing, whatever you want to call it, right, can last a very long time. So the example I gave was as the market was going crazy right here, boom, we started moving higher and higher. We did have a lot of internal weakness, right? We got a very extended reading and we started selling off significantly, basically to July of 2022. And it wasn't until then where we actually put in a higher low and a lower low in the NASDAQ composite, sorry. And that right there is a positive breadth, positive divergence that led to the market rally. Now, during this time here too as well, this kind of lines up with Tom McClellan's chart on that specific ratio we talked about going into 2022. As you can see, we sunk off. So we had that huge surge, right? That huge surge. So the market started pressing higher and higher, and we had the huge surge in the M2 divided by GDP shifted for 12 months. But at the same time, the market was heading higher. right? We had a lot of stocks underperforming. And, you know, if now we look at where we currently stand, right, there is some divergence taking place here. Not as dramatic as this one, but there is a divergence that is currently being built. And this will let me know that if we do start to see the market sell off, it can become oversold very quickly. Okay. And if it reaches way down into these ranges, we can start to look for positive divergences to form. And typically at these lower levels, people start to freak out and get, you know, scared, like the market's it's over and done with. Where, you know, if you're paying very close attention, like we do on this show, you can be ready for the moves to the upside, and that you can see some incredible gains. Another thing that we look at for breadth is NASDAQ record high percent index, and you can see this one is still coming off on the weekly time frame while the market's pressing higher. So we do have a subtle divergence there, but I like to use this one if we get into extreme oversold conditions, say 20. Right, which I'm highlighting here on the screen, and then it crosses back above 35, so you get a breadth thrust back up through that level. It's marked bottoms in the dot-com bust, the financial crisis over here in 2011 going into 12, the 2016 dip there, 2019 fall, and then also, yes, the other one was the 2022 bear market bottom there. Even the 10% correction that we saw in 2023, it caught that level there too as well. So that is an incredibly useful chart to understand that if we get a pullback, if we get some sort of payback, right? If we do more than just a stall out and we really start to sell off, these tools can help identify when more positive breath comes into the market. A couple other things I want to show is some AD lines, so advanced decline lines, and some bullish percent charts. So speaking of a couple AD lines, so the NASDAQ 100, and you can look at an equal weight chart. It looks like this too. So the market has been pressing higher, and yet we're diverging right here as far as the advancers versus decliner lines, okay? The cumulative lines. Here's the S&P 500. You can see this too, as well as declining while the market's pressing higher. We have XLC has a high and a lower high, so we have less, you know, internals playing while the market's pressing higher, so subtle divergence there. XLY, consumer discretionary. This one has about matching highs right here, but yet the market has been going lower, right? And an advanced decline line looks like it's coiling up. So it can always turn back around and go to the upside, but as it stands in this current moment, price action's holding strong. The internals here are showing a little bit of weakness. Consumer staples also matching highs, and this one came off a little bit there too as well. Healthcare as well, which is I found interesting. Healthcare chart, it looks good. It looks well, you know, nicely set up over here, right at this pivot of 147. But the internals are getting a little weak here. So if it turns up, we might see some more strength in individual names in healthcare. But if it breaks down, it may potentially take XLV with it. If we take a look at the energy sector, this one I found interesting because energy's been kind of sinking off, right? Well, up until recently on this 50% retracement level, and yet the advanced decline line is holding rather strong. So is there opportunity in here? Is oil going to continue to rally, right? Or is the 10-year yield going to rise or stay elevated? And is that going to help out with, you know, these assets? That's always a possibility, and I think we can keep an eye out for that. Let's look at some bullish percent charts. So the bullish percent chart is just showing us the percent of stocks in whatever asset that we're looking at, this one being the NASDAQ composite. The percent of stocks that are on buy signals based off of the tic-tac-toe charts, right? The X and O charts, okay, point and figure. So right now what I'm just calling out is the percent of stocks on buy signals, they have been actually declining, right? But yet the market's been pressing higher. So it's just diverging a little bit, but no extreme readings on the RSI. I just wanted to point that out. BPGDM, so this is the gold miners. This one got pretty extended on the weekly time frame, mind you. The other ones are on the daily. Weekly, it got frothy, and it's coming in a little bit there. The industrials, so this one was interesting, right? We put in a lower low, but we put in a higher low right here. And today we saw things like FDX scream higher on earnings. So this positive divergence may very well be resolving itself with that sector. The NYSE bullish percent index, the market itself has been rather going flat, but I did notice we have a lower low, but we do have a higher low right here. So we have positive divergence building in more of a broader market. Albeit that, you know, it's not that low of a reading. When it gets, you know, lower readings and we get these bullish divergences, like for example, right here, that was super significant because it marked the November bottom after seeing that correction here, and it led to a monster rally, which was quite nice to to see. But you can see that we did have a high, a lower high, a higher high, and then we also had a divergence there that led to this kind of selling activity that we saw in the New York Stock Exchange. The energy sector, we're right there in oversold condition. This one we talked about when it was very extended to the downside. It's a little bit more blocky and choppy looking of a chart, but nevertheless, does this mean that we're at a low reading? We could potentially move up to see some other energy names perform. It's a possibility. Financials also, we have a low, a lower low. We have a high and a higher low. So we have a low and a higher low right there. So is financials potentially going to start to move up a little bit? Another note that I just like to call out is that it's not like it's an extended reading to the downside. It's still 65% right now. So to see this come back down and this drop, I mean, that could make some sense as financials is just consolidating in this current moment though. Materials also, we have a low and a higher low, a low and a lower low reading right there. So is materials potentially going to catch some sort of a bid here in the near future? Well, we do have, like I said, some oversold conditions there as well. And then we have the real estate sector showing us something a little different. We have a high and a higher high in real estate, and we have a high and a lower high. So we have a negative divergence in real estate going on right now. So does this mean that real estate potentially might be taking a little bit of a back seat and coming in? To be continued, that's for sure. We'll keep an eye and see how all this stuff develops. But after everything, just to kind of conclude, we're at a very key level in terms of gamma. This is where we can get pinned at the 5,500 and stall out. I'd be bullish above 5,500. I'm really bullish above 5,450, which is the gamma flip line. But when we start breaking those levels, if we start breaking those levels, that's where I proceed with a little bit of caution. We are coming into a seasonal standpoint where things tend to stall out, and we're getting some interesting charts over here saying that we may be due for a payback in the markets. That's all I got for you on today's episode, everybody. Hope it helps out, gives you some insight. See you later.